Gold's insane $5.5 trillion swing in one day. History created between 9:30 a.m. and 10:25 a.m. Eastern. $3.2 trillion evaporated. $58 billion per minute gone. Then, in 6.5 hours, $2.3 trillion roared back. Goldman Sachs called 5/14 $100 1 week ago. Already shattered. JP Morgan now sees $8,500, a 52% climb from here. But here's what they're not telling you. The volatility now exceeds 2008 crisis levels, and institutional money is making a move most will miss until it's too late. And welcome to John A.G. You know, I've learned something over the years. The wisest folks I know, the ones who've seen markets rise, crash, and rise again, they don't just watch the news. They study the patterns the news won't show you. If that's you, if you appreciate unfiltered economic analysis without the mainstream sugarcoating, do me a favor, would you? Hit that subscribe button like you're locking in a position you know makes sense. No games, no hype, just the strategic edge you need. And drop a comment. Tell me where you're watching from. New York, London, Mumbai, Tokyo. I'm curious to know where the sharp minds are gathering. Now, let's get into what just happened and why it changes everything. On a single trading day, the gold market experienced something that had never happened before in recorded financial history. $5.5 trillion. That was the total swing in gold's market cap between the opening bell and closing bell. To put this in perspective, Japan's entire economy, the third largest in the world, produces roughly $4.2 trillion in GDP annually. Gold moved more value in one day than Japan creates in an entire year. The sequence of events unfolded with brutal precision. At 9:30 a.m. Eastern Time, the market opened. By 10:25 a.m., just 55 minutes later, gold had lost $3.2 trillion in market capitalization. Analysts watching their screens couldn't believe the numbers. $58 billion per minute was vanishing from the gold market. Every 60 seconds, $58 billion gone. Traders who had positioned themselves long on gold watched their portfolios hemorrhage value at a rate most had never witnessed. The selling pressure was relentless. Automated trading systems kicked in. Stop losses triggered across institutional desks. Margin calls went out to leveraged players. For 55 minutes, gold was in free fall. Then something changed. At 10:25 a.m., the bleeding stopped, and the reversal began. Between 10:25 a.m. and 4:00 p.m., a span of 5.5 hours, gold added back $2.3 trillion in market cap. The recovery rate was staggering. $850 billion per hour was flowing back into gold. Every single hour. For 5.5 consecutive hours, $850 billion returned. To understand the magnitude of this movement, consider Bitcoin. The entire cryptocurrency, all Bitcoin that exists, has a market cap of approximately $1.7 trillion. And gold's swing in just 6.5 hours was 3 times larger than Bitcoin's entire valuation. 3 times. This wasn't a normal market correction. This wasn't even an abnormal market correction. This was something entirely different. Market veterans who had traded through Black Monday in 1987, who had survived the 2008 financial crisis, who had navigated the March 2020 COVID crash, were calling colleagues. Are you seeing this? The volatility measurements told the story in technical terms. Gold's current volatility index, the mathematical measure of price swings, had exceeded the levels seen during the 2008 financial crisis. The year Lehman Brothers collapsed. The year the global financial system nearly imploded. The year central banks had to intervene with trillions in emergency liquidity. Gold's volatility was now higher than that crisis moment. For decades, gold had been known as the stable asset, the boring asset, the thing retirees bought for safety and preservation, the asset that moved slowly, predictably, without drama. That reputation died in 6.5 hours. Gold had transformed from a stability instrument into a high volatility vehicle. And this transformation carried profound implications. Portfolio managers who had allocated 2% to 5% of their funds to gold as a stable diversifier were now holding an asset that could swing billions in minutes. Risk management models built on historical volatility data were suddenly obsolete. The assumptions that guided institutional allocation decisions for the past 40 years were breaking down in real time. But here's what made this event even more significant. This wasn't happening in isolation. This volatility explosion was occurring against a backdrop of accelerating institutional interest. Major banks weren't running away from gold. They were raising their price targets aggressively. Goldman Sachs had published a $5,400 per ounce target just 7 days earlier, 1 week. That target had already been exceeded by reality. Deutsche Bank had released a $6,000 target the day before. And today, On the same day as this historic swing, JP Morgan published analysis showing a potential path to $8,500 per ounce. Think about that sequence. $5,400, $6,000, $8,500. Each projection higher than the last, each timeline shorter than the previous. The institutional forecasting models were being updated in real time because reality kept outpacing the predictions. JP Morgan's $8,500 target represented a 52% increase from current price levels. 52%. Not 5%, not 10%, but 52%. And this wasn't coming from a gold bug newsletter or a conspiracy theory website. This was JP Morgan, one of the largest and most influential financial institutions on the planet. The same institution that manages trillions in client assets. The same institution whose research desks are staffed by some of the most sophisticated analysts in global finance. They were now plotting a course to $8,500 gold. Something fundamental had shifted. The question facing every investor, every business owner, every financial decision maker was simple but urgent. Was this chaos, or was this the new order? The answer would determine who prospered and who perished and what came next. While traders were still processing the chaos of the $5.5 trillion swing, something quieter but far more significant was happening in the research departments of the world's largest banks. They were rewriting the playbook, not updating it, not adjusting it, rewriting it completely. 7 days earlier, Goldman Sachs had released their gold forecast, $5,400 per ounce. At the time, it seemed bold, even aggressive. Their analysts had run the models, factored in central bank buying, considered geopolitical tensions, and arrived at $5,400. The report went out to clients. Portfolio managers took note. Some adjusted their allocations accordingly. Then reality moved faster than the models. Within 1 week, gold had blown past Goldman's target. Their aggressive forecast was already in the rearview mirror. The following day, Deutsche Bank published their analysis, $6,000 per ounce, 11% higher than Goldman's week-old projection. But Deutsche Bank's report wasn't just a higher number, it was a different thesis entirely. They weren't just forecasting price movement, they were identifying a structural shift in how global capital was being allocated. Then came today. JP Morgan's research desk released their findings, $8,500 per ounce, a pathway, not a ceiling, 52% upside from current levels. And buried in their analysis was a single paragraph that explained everything. The analyst, Nicholas Penglu, had identified the mechanism driving this unprecedented move. Private investors, households, family offices, individual portfolios currently held approximately 3% of their total assets in gold. 3%. That's the baseline. The historical average. The comfortable allocation that financial advisors had recommended for decades. But Penglu's analysis showed something remarkable. If private investors increased their allocation from 3% to just 4.6%, just 1.6 percentage points, the impact would be seismic. Now here's where the mathematics become critical. The global investable asset base, all the stocks, bonds, cash, and alternative investments held by households worldwide, totals approximately $200 trillion. $200 trillion sitting in various investment vehicles across the planet. A 1.6% shift doesn't sound dramatic. Until you multiply it by $200 trillion. 1.6% of $200 trillion equals $3.2 trillion. $3.2 trillion of new demand, flowing into a market with a total capitalization of roughly $40 trillion. Think about that ratio. New demand worth $3.2 trillion entering a $40 trillion market. That represents an 8% increase in total market demand. But markets don't move linearly. When demand increases by 8%, prices don't rise by 8%. They can rise by 20%, 30%, 50%, or more. Because the gold market, despite its size, has limited liquidity at the margins. Most gold is locked up. Central banks hold it in vaults and rarely sell. Jewelry demand consumes massive quantities that never return to investment markets. Industrial applications absorb steady supply. The amount of gold actually available for investment trading is far smaller than the total market cap suggests. So when $3.2 trillion in incremental demand hits a market where most supply is effectively frozen, price discovery becomes violent. And JP Morgan's analysis revealed 3 distinct forces driving this allocation shift. First, the safe haven bid. Capital was fleeing risk assets and seeking refuge, not because of a single crisis, but because of multiple simultaneous instabilities. Geopolitical tensions weren't resolving. They were multiplying. Currency volatility wasn't stabilizing, it was accelerating. Investors weren't looking for yield, they were looking for preservation. Second, central bank accumulation. For the past 2 years, central banks globally had been net buyers of gold at rates not seen in decades. China's central bank, Russia's central bank, India's central bank, Poland's central bank, even countries traditionally aligned with dollar system stability were diversifying their reserves. This wasn't speculation. This was strategic national policy. Countries were actively reducing their exposure to any single currency system and increasing their gold holdings. When central banks move, private capital pays attention. Third, the bond market exodus. JP Morgan's analysis noted a critical shift away from long-term sovereign bonds. For 40 years, government bonds had been the foundation of conservative portfolio construction. Safe, stable, predictable. But something had broken. Real yields, after adjusting for actual inflation, had turned deeply negative in many developed markets. Investors holding long-term bonds weren't preserving wealth. They were guaranteeing losses. The mathematical certainty of losing purchasing power had driven sophisticated allocators to seek alternatives, and gold was emerging as the primary beneficiary. But here's what separated gold from other alternatives: liquidity. JP Morgan's research emphasized this explicitly. Gold demonstrated superior liquidity and market depth compared to silver or Bitcoin. Silver's total market cap sat around $1.4 trillion, too small to absorb institutional-scale capital without causing massive price distortions. Bitcoin's market cap was roughly $1.7 trillion, but its volatility and liquidity constraints made it unsuitable for large institutional treasuries moving billions. Gold's $40 trillion market, its centuries of price history, its deep global trading infrastructure, these factors made it the only viable destination for truly massive capital flows. When a sovereign wealth fund needs to deploy $50 billion, they need a market that can absorb that capital without breaking. Gold could handle it. Silver couldn't. Bitcoin couldn't. This was the institutional allocation war, and gold was winning. Not because of hype, not because of social media momentum, but because of fundamental market structure. The feedback loop was now in motion. Institutional buying drove prices higher. Higher prices validated the allocation thesis. Validation drove more institutional buying. And somewhere in the middle of this loop, the $5.5 trillion daily swing had occurred. Not as chaos, but as recalibration. The market was discovering a new price range in real time, and the institutions publishing $8,500 targets weren't guessing. They were calculating what happens when $3.2 trillion chases limited supply. The question wasn't whether this would continue. The question was whether decision makers would recognize it before the opportunity window closed. Behind every major market movement lies a trigger, but behind every historic market transformation lies something deeper, a foundation that has been cracking for years, invisible fractures spreading beneath the surface, until one day the structure can no longer hold. Gold's $5.5 trillion swing wasn't the cause, it was the symptom. The real story begins with a number that most people have stopped paying attention to: $100 trillion. That's the total sovereign debt currently sitting on government balance sheets worldwide. $100 trillion in promises to pay, obligations that governments have made to bondholders, to pensioners, to social programs, to infrastructure projects. And here's the mathematical reality that no politician wants to acknowledge. There is no scenario where this debt gets repaid in full value. None. The numbers don't work. Government revenues can't cover the obligations. Economic growth rates can't outpace the debt accumulation. The only question is how the debt gets resolved. And throughout history, there have only been three methods: default, austerity, or currency debasement. Default destroys political careers and triggers social unrest. Austerity requires cutting services that voters depend on. So governments always choose the third option. They print. Since 2008, central bank balance sheets have expanded from roughly $5 trillion to over $25 trillion. $20 trillion in new currency created. Not backed by gold. Not backed by production. Backed only by the promise that the currency would retain value. But promises don't override mathematics. When currency supply increases by 400% while productive output increases by 30%, the currency loses purchasing power. It must. There's no economic theory that prevents it. Only timing determines when the market recognizes reality. And, increasingly, the market was recognizing it. Real interest rates told the story clearly. A real interest rate is the nominal rate minus actual inflation. If a bond pays 4% and inflation runs at 6%, the real return is negative 2%. The bondholder is losing purchasing power, guaranteed. Across developed economies, real rates had turned negative. Japan's real rates, negative. Europe's real rates, negative. Even U.S. real rates, when measured against actual consumer price increases rather than official statistics, were negative. Investors holding long-term government bonds weren't earning returns. They were accepting guaranteed losses. This created a crisis for institutional portfolios. Pension funds need positive real returns to meet future obligations. Insurance companies need safe assets that preserve value. Sovereign wealth funds need stores of wealth that maintain purchasing power across generations. But the traditional safe asset, government bonds, had become a wealth destruction vehicle. So capital began searching for alternatives, and simultaneously, a second pressure was building: de-dollarization. For 70 years, the US dollar had served as the world's primary reserve currency. Countries held dollars, commodities priced in dollars, international trade settled in dollars. This arrangement gave the United States extraordinary privilege: the ability to run perpetual trade deficits, the ability to finance government spending through foreign bond purchases, the ability to use financial sanctions as geopolitical weapons. But every privilege eventually faces a reckoning. Between 2022 and 2024, central bank gold purchases accelerated dramatically. China's central bank bought gold at the fastest pace in decades. Russia diverted currency reserves from dollars into gold. India increased gold holdings beyond historical norms. Poland, Turkey, Singapore. Nations across the geopolitical spectrum were making the same move. They were diversifying away from dollar dependency, not abandoning dollars entirely, but reducing concentration risk. And their chosen alternative wasn't euros or yen, it was gold. Because gold carries no counterparty risk. It can't be frozen by sanctions. It can't be devalued by another nation's monetary policy. It exists outside any single country's control. In a fragmenting geopolitical order, that property became invaluable. The United States had reduced foreign holdings of Treasury securities by over $1 trillion in 3 years, not because the U.S. defaulted, but because foreign central banks were systematically reducing exposure, and they were rotating that capital into gold. This wasn't a temporary trend. This was strategic repositioning. Then came the third catalyst: geopolitical instability. Not a single crisis, but a cascade of overlapping tensions. Trade routes were being weaponized. Supply chains were fracturing along political lines. Military conflicts were escalating in multiple regions simultaneously. Sanctions regimes were expanding in scope and frequency. Each sanction demonstrated that holding another nation's currency carried political risk. Each supply chain disruption proved that global integration could reverse quickly. Each trade barrier showed that the post-Cold War consensus was dissolving. In this environment, gold's properties became strategically critical. It was politically neutral. No government controlled it. No sanctions could freeze it. No trade war could devalue it. For nations navigating a multipolar world, gold was the only universally accepted reserve asset. But the final catalyst was perhaps the most dangerous. Central banks were trapped. Inflation required higher interest rates, but higher rates would make government debt unsustainable. The mathematics were brutal. If interest rates rose to 6% and government debt stood at $100 trillion, annual interest payments alone would exceed $6 trillion. Most governments couldn't generate enough revenue to cover that. Higher rates would trigger sovereign debt crises. So central banks faced an impossible choice: raise rates and crash government finances, or keep rates low and allow inflation to run. Either path led to currency debasement, either path drove capital toward hard assets. And the window for easy solutions was closing. For 40 years, from 1981 to 2021, interest rates had fallen steadily. Bonds had been in a historic bull market. Portfolio construction assumed this would continue. 60% stocks, 40% bonds. The classic allocation that had worked for decades. But when the bond bull market ends, the entire portfolio framework breaks. Stocks and bonds can fall simultaneously. Diversification within financial assets provides no protection. Investors need something outside the traditional system, something that doesn't depend on government promises, something that can't be printed, something with 5,000 years of monetary history. Gold was the answer to a problem most investors were just beginning to understand. The $5.5 trillion swing wasn't random chaos. It was the market trying to price in a new reality, a reality where currency stability could no longer be assumed, where government debt had become unsustainable, where geopolitical order was fracturing, where the old rules no longer applied, and the institutions moving billions into gold weren't panicking. They were reading the same macroeconomic data, drawing the same conclusions, making the same strategic adjustments. The question facing every business leader wasn't whether this shift was real. The data proved it was real. The question was whether they would adjust their strategy before the adjustment became forced. Because in regime changes, the early movers positioned themselves advantageously. The late movers pay premium prices for protection they should have secured earlier. And those who never adjust, they learn expensive lessons about what happens when foundational assumptions prove false. Understanding what happened is valuable. Knowing what to do about it is essential. The $5.5 trillion swing, the institutional target revisions, the macroeconomic catalysts. All of this information becomes worthless without a framework for action. Business leaders face a decision point. Not someday. Now. Because the cost of strategic positioning changes with every passing day. The first question every decision maker must answer is deceptively simple. What percentage of liquid reserves should be allocated to hard assets? Traditional portfolio theory suggested 2% to 5% in gold. A small hedge? a minor diversification, something to hold just in case while the real wealth accumulated in stocks and bonds. But that framework was built for a different era. An era of declining interest rates, an era of stable currency systems, an era of predictable geopolitical order. That era has ended. JP Morgan's suggestion of 4.6% allocation represents conservative institutional positioning. Not aggressive, not speculative, conservative. The baseline expectation from one of the world's most risk-averse research departments. But here's what that number actually means in practice. For a business holding $10 million in liquid reserves, 4.6% means $460,000 in gold. For a portfolio worth $100 million, it means $4.6 million. For institutional capital managing billions, the numbers scale proportionally. And the question becomes, is 4.6% enough? Some analysts were privately circulating higher figures, 7%, 10%, even 15% for portfolios expecting severe currency instability. The appropriate allocation depends on three factors: time horizon, risk tolerance, and conviction in the thesis. But regardless of the exact percentage, the directional decision remains the same: increase hard asset exposure beyond traditional norms. The second question involves implementation: physical gold, ETFs, futures contracts, mining company equity. Each vehicle carries different characteristics. Physical gold provides complete ownership with no counterparty risk, but it requires secure storage, insurance, and lacks liquidity for large positions. Gold ETFs offer liquidity and ease of trading, but they introduce counterparty risk and don't provide actual metal ownership. Futures contracts enable leveraged exposure, but they require active management and carry significant rollover costs. Mining stocks offer operational leverage to gold prices, but they introduce company-specific risks completely unrelated to gold's monetary properties. For strategic reserves meant to preserve wealth across monetary instability, physical gold and highly liquid ETFs backed by allocated metal represent the most appropriate vehicles. For tactical trading positions, attempting to capture short-term momentum, futures and mining stocks provide greater flexibility. The choice depends on objective. Preservation versus speculation require different tools, but here's where the complexity deepens. Today's $5.5 trillion swing revealed gold's new volatility profile. The stable asset had become volatile. The boring investment had become dynamic. This transformation creates a management problem. Companies allocating 5% to gold expecting minimal price movement. Now hold an asset that can swing billions in hours. Treasury departments built around stable asset allocation. Now manage positions experiencing equity-like volatility. Risk models calibrated to historical data now face volatility regimes exceeding 2008 crisis levels. This requires new protocols. Position sizing must account for increased volatility. Rebalancing triggers need adjustment. Exposure limits require recalibration. The old playbook doesn't work when the asset behavior has fundamentally changed. Some firms were implementing volatility-adjusted position sizing. Instead of fixed percentage allocations, they calculated position size based on current volatility levels. Higher volatility meant smaller positions to maintain equivalent risk exposure. This approach prevented a stability hedge from becoming a source of portfolio instability. Others were using options, strategies to cap downside while maintaining upside participation, buying protective puts, selling covered calls, constructing collars around core positions. These techniques added cost but provided defined risk parameters. The sophistication required to manage gold exposure had increased dramatically. Then comes the most difficult question: timing. JP Morgan's $8,500 target implies 52% upside from current levels. Deutsche Bank sees $6,000. Goldman's $5,400 has already been exceeded. The institutional consensus points towards significantly higher prices, but markets don't move in straight lines. The $3.2 trillion loss in 55 minutes proved that momentum can reverse violently. Profit-taking can trigger cascading liquidations. Over-leveraged positions can force selling regardless of fundamental thesis. Short-term pain can occur even within long-term bull markets. History provides cautionary examples. In 1980, gold peaked at $850 per ounce. Adjusted for inflation, that's roughly $3,200 in today's dollars. After that peak, gold entered a 20-year bear market. It didn't regain its inflation-adjusted high until 2008. 20 years. An entire generation of investors who bought at the top waited decades to break even. The risk of buying at a temporary peak is real, but the risk of waiting is equally real. Every day gold rises, the entry price increases. Every week institutional flows accelerate. The available supply diminishes. Every month the macroeconomic catalysts intensify. The urgency compounds. This creates a painful paradox. Acting now means buying after significant appreciation. Waiting means potentially paying even higher prices later or missing the position entirely. The resolution requires honest assessment of 4 critical questions. First, what percentage of liquid reserves should be allocated to hard assets given current monetary instability? Second, how does gold's new volatility profile compare to the currency devaluation risk it's meant to hedge? Third, what is the appropriate time horizon for this positioning? 3 years? 5 years? 10 years? Fourth, how should allocation strategy adjust if JP Morgan's thesis proves correct and gold reaches $8,500? These questions don't have universal answers. A pension fund with 30-year liabilities answers differently than a corporate treasury managing quarterly operations. A family office preserving generational wealth answers differently than a hedge fund seeking annual returns. But every decision maker must answer them, because not deciding is itself a decision. It's a decision to maintain current positioning, a decision to accept whatever currency stability exists, a decision to bet that the macroeconomic pressures will resolve favorably, and that bet may prove correct. Central banks might successfully navigate the debt trap. Geopolitical tensions might ease. Currency systems might stabilize. The institutional forecast could be wrong. It has happened before. But here's what makes this moment different. The cost of being wrong versus the cost of being late creates asymmetric risk. If the institutional thesis proves incorrect and gold declines, a 5% to 10% allocation represents manageable portfolio impact. Disappointing, but not catastrophic. But if the thesis proves correct and gold reaches $8,500 while someone waited, the entry price has increased 52%. The position that could have been built at $5,500 now costs $8,500. The protection that could have been secured cheaply now requires premium pricing. In monetary regime changes, the early movers capture advantage, the late movers pay the price of delay. And those who never adjust, they discover that preservation of wealth requires active decision-making, that maintaining status quo during structural change is the highest risk position of all. The $5.5 trillion swing was not chaos. It was a signal. The institutional money is repositioning. The question facing every business leader is simple. Do they recognize the same shift? And if they do, what are they prepared to do about it?